Welcome to The Explainer. Today, we're diving into the wild world of international trade, where a perfectly normal business deal can suddenly feel like a high-stakes gamble against the crazy swings of the foreign currency market.
So let's just kick things off with a scenario. Imagine your company closes a big sale. You're expecting a payment of a cool £5 million. Awesome, right? But when that money finally hits your bank account, you see you're short by over £121,000. That money is just gone.
So how on earth does that happen? This isn't some shady accounting or a Wall Street trading floor error. No, this is a risk that thousands of completely normal businesses have to deal with every single day when they sell their stuff overseas. Okay, so let's break this down.
So here's the scene. We're following a company based in the UK. They make stuff and they export it to a customer over in the United States. And they've just landed a pretty big deal.
They agree on a price of $8 million. It's a fantastic sale for them. But there's a catch, and it's a super common one in the world of business-to-business deals. The customer gets 3 months to pay up. Now, this is standard practice, it's called trade credit, and it's great for building relationships. But for our UK company, this 3-month waiting period, well, that's the danger zone.
To really get why that gap is so risky, we need to take a quick peek behind the curtain at the cause of all this chaos, the foreign exchange market. You've probably heard it called FX.
Think of it like a giant, invisible 24/7 marketplace that wraps around the entire globe. It's where currencies, like the British pound, are constantly being traded against other currencies, like the US dollar. We're talking trillions of dollars worth every single day. It's massive.
And here's the absolute key thing you need to know about this market. In the short term, and that 3-month invoice for our exporter is definitely short term, the market is a total roller coaster. It is incredibly volatile and for all intents and purposes completely unpredictable.
Okay, so in this world, there are two key prices you got to know about. First is the spot rate. That's the price you'd get if you wanted to swap currencies, well, right here on the spot. But then there's the forward rate, and this is cool. This lets you agree on a price today for a currency swap that you're going to make sometime in the future. Now hang on to that idea of a forward rate. It is going to be super important in a minute.
So this crazy, unpredictable market doesn't just create one little problem. For any company that operates internationally, it actually creates 3 very distinct types of risk.
You've got long-term economic risk, then there's what's called translation risk, which is more of an on-paper accounting thing. But our exporter, they are staring down the barrel of the most immediate cash-in-your-pocket threat of them all, transaction risk.
So what is that? Well, it's the very specific risk that during that 3-month window between the handshake and the payday, the exchange rate between the dollar and the pound is going to move against them. And if it does, it literally shrinks the value of that $8 million payment when they go to convert it back into pounds.
So here's the crucial question. Are they helpless? Do they just have to cross their fingers for 3 months and pray that the currency markets are feeling generous? Well, no. The good news is there are powerful, concrete strategies they can use to fight back. All right, let's get to the good part, the solution. To wipe out all this uncertainty, companies use a set of financial tools called hedges. In plain English, hedging is basically like buying insurance for your money. It's a specific action you take today to guarantee you don't get a nasty surprise in the future. So let's look at the 2 most popular ways our exporter could do this. First up, and this is the most common one, is the forward market hedge. Hey, remember that forward rate we talked about? This is its moment to shine. The company essentially calls up their bank and pre-orders their currency exchange. They lock in a price today to swap their $8 million for pounds in 3 months' time. Simple, clean, effective.
Okay, the second method is called the money market hedge. Now, this one's a little more, let's call it creative. It involves borrowing money in one currency, swapping it, and then paying it back later. Look, the mechanics are a bit more complex, but don't get bogged down in the details. The end goal is exactly the same, to create a 100% guaranteed outcome today.
So what's the bottom line for our exporter? Well, this table lays it out perfectly. If they use the forward hedge, they lock in a guaranteed receipt of just over £4.97 million. The money market hedge gets them a tiny bit less, but it can be more flexible if the customer pays early or late. But here is the absolute most important thing to see here. It's not about which number is bigger. With either of these methods, the company now knows, down to the penny, exactly how many pounds it's going to get in 3 months. The risk, the gamble, the uncertainty, it's all gone, vanished.
And this really gets us to the biggest question of all.
Why go through all this trouble, right? I mean, why not just roll the dice? Maybe the market will move in your favor and you'll make even more money.
Well, it all comes down to this core idea. The job of a company's finance director isn't to be a gambler. They're not paid to try and outsmart the chaotic currency markets. Their job is to manage the actual business, making great products and selling them to happy customers.
When a company hedges, it's not trying to beat the market. It's not trying to squeeze out an extra profit. It is making an active choice to take itself out of the game. It's choosing certainty over chance. And that certainty stabilizes their cash flow, it lets them plan for the future, and ultimately, it makes the entire business stronger and more valuable.
And that's really the key takeaway here. For any business that operates across borders, choosing not to hedge isn't playing it safe. It's not the neutral option. It is an active decision to speculate, to gamble. It's leaving your company's hard-earned profits completely at the mercy of a chaotic, unpredictable global market. And in today's economy, that might just be the biggest gamble of all.